Okay. Yeah. Good morning to all members of STEP Branch Mauritius, friends and colleagues. The Board of Directors of STEP Branch Mauritius, jointly with AfrAsia Bank, welcome you all to the webinar of today. First of all, we wish to thank AfrAsia for providing the opportunity and setting up this platform to join you all for the presentation of today by Mr. Mark Korten. Mr. Mark Korten has kindly agreed to share his expertise and own experience of the impact of the tax status of a foreign settler who, after having established a Mauritian Trust, has changed his tax residency to Mauritius. After his presentation, you will be given the chance to ask Mr. Korten any further clarifications you may need through the question and answer session. As the chairperson of STEP Mauritius, it provides me great pleasure to introduce Mr. Korten, who was admitted as an attorney of the High Court of South Africa in 1996, where he practiced as a commercial and tax partner for 13 years. 10 years ago, Mark moved to Mauritius and was the second foreign lawyer to be registered in Mauritius in 2010. And since then, he has been acting as an independent legal advisor on financial tax and commercial issues relating to cross-border transactions. Mark holds 3 university degrees, a Bachelor of Commerce from the University of Cape Town, a Bachelor of Laws, and a High Diploma Master's in Tax Law. Mark has over 25 experience in specializing in advising clients on investment and business issues involving tax and commercial law. His specialization in tax law relates to local and international estate planning, international tax consequences of, and African exchange control issues relating to cross-border transactions and international group structures, as well as tax experience relating to all types of transactions involving tax law in South Africa and Mauritius. Mark and his family decided to emigrate from South Africa to Mauritius in late 2008, where he remains a permanent resident and has become a Mauritian national. From his credentials alone, Mark is well poised to give us his insights on the tax status of a foreign settler of a Mauritian immigrating to Mauritius and the best ways to go about it. Without any further delay, I invite my tuteless more. Thank you.
Thank you very much. Good morning or good afternoon, everyone, depending where you are. Thank you for joining. Thank you for that nice introduction. At the end of the day, I have been in Mauritius now for 10, 12 years, so obviously I've become quite well acquainted with the Mauritian laws. With international changes and pressure on low tax jurisdictions such as Mauritius, the tax laws here have changed quite materially insofar as they affect expatriates in particular and cross-border business. So it's not a one-size-fits-all anymore, and part of what I'll be taking you through today will be focused specifically on Mauritian trusts that were established by foreign tax residents who subsequently are looking to become tax resident, which is a little bit of a trend that's happening at the moment. As mentioned, please post your questions. I'm going to try and keep it to 35-40 minutes and take you through the topic. There's quite a lot to cover, so I may rush here and there. But in the meantime, if you have questions, please post them. And for the last 20 minutes of our session, I'm going to do my best to answer those questions. All right, so let's get stuck into it. I'm just putting up the slides. Okay, so there's our topic, tax and planning issues involving a Mauritian trust established by a foreign settler who subsequently becomes a Mauritian tax resident. So that is the starting point here. So let's just paint the picture, the trends and assumptions. Why is this topic so relevant? And how are we sort of ring fencing the discussion in order to crystallize the issues that I'd like to illustrate. Firstly, I'm going to make the assumption that we're dealing with a Mauritian tax resident trust that was established before the settler became a Mauritian tax resident. And now the settler is looking to terminate his previous tax residency and now is going to be only a Mauritian tax resident. So whether that is terminating tax residency based on the domestic tax laws of his previous country of residence, or in terms of the double tax treaty that may exist between Mauritius and his previous country of tax residence, he'll now only be tax resident in Mauritius. So the topic and the tax issues are going to be solely dedicated to Mauritian tax issues and not tax issues that may apply elsewhere. Then looking at the trust in question, usually what has happened in the past and the way in which the Mauritian offshore sector has promoted itself with respect to trusts is that foreigners are encouraged to form trusts in Mauritius, where the Mauritian Trust has an effective tax exempt status under Section 46(3) of the Mauritian Income Tax Act. I'll refer to that legislation as the MITA, on the basis that for the year in question, so each year you apply for, it's actually a statement of non-residency, which is a bit of a misnomer because according to the law, the trust is resident in Mauritius and that its trustees and administration is based in Mauritius. I'll take you through the tax residency of a trust according to Mauritian law in a bit more detail in a moment. But effectively what would have been happening is there would have just been an annual exemption from any tax with respect to that Mauritian trust on the basis that the settlor and the beneficiaries, all the beneficiaries for that year are not residents of Mauritius. Now, obviously, we're looking at a situation where the settlor and all residents, beneficiaries will become tax residents of Mauritius. So now that exemption status will fall away and that Mauritian trust will become a taxable entity in Mauritius. And in fact, it'll be treated almost in all respects the same as a domestic Mauritian company. I'll take you through that in a second in a little bit more detail. So why is this topical? You know, as we all know, the political and economic climate, possibly exacerbated by the COVID pandemic, has resulted in a lot of people who previously chose to live in countries such as South Africa, maybe certain other African countries, possibly places like France and elsewhere, because of political and economic unrest and pressures. South Africa, for example, is in a very bad place, unfortunately, at the moment. There's a lot of consideration being given for people to actually move their place of residency. That's also been further pressure for that type of decision has taken place by virtue of BEPS initiatives, your base erosion and profit shifting rules that are coming out worldwide as an EU OECD initiative to basically stop tax treaty shopping, to stop transfer pricing and artificial arrangements where jurisdictions such as Mauritius are being used solely as a means to save tax rather than for bona fide commercial and business purposes. The MLI, the Multilateral Initiative, is your anti-tax treaty shopping instrument, which you may well be familiar with. I can't take you through in detail what it is due to limited time. But the bottom line is that if one has particularly an active trading business that one says is resident in Mauritius for tax purposes, you have to have substance. So gone are the days where management companies in Mauritius could be really by proxy so-called manage the business or act as directors for a business that in practice they really don't have the necessary expertise to understand and make executive decisions. And it is becoming appropriate for either senior managers to move to Mauritius and to run the business from Mauritius and create that substance, have offices, have staff, or the owners of those businesses or part owners of those businesses base themselves here and on that basis are able to justify that Mauritius is a bona fide, it's a legitimate base from which to conduct business, and it's not just being used because of its DTA benefits and its low tax environment. So that's often what's sort of promoted people looking to move to Mauritius, either the owners of businesses or senior managers or part owners. Okay, so the brief from the settler here is, okay, I had a Mauritian trust established, it was tax-free, I had possibly a GBC set up, some kind of trading activity, the shares were held in the GBC, were held by my trust for various reasons, estate planning reasons, tax planning reasons. Now I'm leaving, I'm going to use South Africa because that's obviously most familiar to me. I'm leaving South Africa, I'm terminating my tax residency in South Africa, I'm moving to Mauritius. Do I still need the trust? If so, is it appropriate that the trust is still a Mauritian tax resident trust, or should the trust move somewhere else, or should I start a trust somewhere else? This is now becoming a Mauritian tax planning issue. So this is really the nub of what we're going to need to deal with. Okay, Let's look at the relevant factors for planning advice. Now, like most things, there's no vanilla structure or vanilla solution to say, yes, you need your Mauritian Trust. No, you don't. It's very much a case-by-case analysis depending on the circumstances and plans and various factors that may make having the Mauritian Trust stay in Mauritius a good idea versus it's possibly better to move it out of Mauritius. And we'll illustrate the pros and cons of each. And I will also illustrate to you that in fact it's become more important than ever before to have your Mauritian Trust, particularly by virtue of the tax laws of Mauritius that are penalizing quite heavily the taxation of individuals, where trusts and companies in fact do not have that stigma attached to it. In fact, the tax rates of trusts and companies is significantly lower than for individuals. So that requires the use of trusts as a planning option. Unlike, for example, those of you who are attending who are familiar with the South African side of things, as you know, for many years, South Africa, the South African authorities, tax authorities, SARS, has done their best to penalize the use of inter vivos family trusts and really creating a worse off tax position. Mauritius is quite the opposite, at least at this point in time, where you're actually in a far better off position. And I'll illustrate that as we go along. So short and long-term Mauritian residency plans. How long is the client planning to be in Mauritius, the settlor, the beneficiaries, under what circumstancing, understanding their global wealth and the ability to efficiently move ownership of assets to different jurisdictions. I will illustrate that for the ultra-high net worth individual, someone with significant foreign wealth, moving that wealth into a Mauritian Trust as a Mauritian resident is probably not the greatest idea. And there are different ideas to possibly leave that in an offshore trust that's outside Mauritius, but there are also going to be challenges to establish a trust outside Mauritius once you've already taken up Mauritian tax residency. Considering the existing legal structures in Mauritius and elsewhere that person has, it's a holistic analysis to then look at the pros and cons, because there isn't one clear solution and clear beneficial solution that fits everybody. What the settler is doing in Mauritius is important. You know, are they there as a retiree with an investor permit? What the source and nature of the income that they're earning is actually very important in the tax planning from a Mauritian perspective. Are they earning salary? Are they going to be earning dividends from their GPC? Is it passive income from investments? And is the source of that income Mauritian or foreign? You know, as far as trusts and companies are concerned, Mauritius effectively has a worldwide residency-based system of taxation. But for individuals, it's interesting. It's more the source-based system of taxation with a remittance rule that the foreign sourced income that an individual earns that is remitted to Mauritius then becomes taxable, but only then. So these are all issues that one needs to take into consideration. What's very important is, where's the settler spending his income? Does he require to spend income in Mauritius? Will he need to draw funds out of his trust in order to consume in Mauritius, in order to pay for his dependents' expenses in Mauritius? Or will that more be an issue that those expenses will be outside Mauritius? That will also influence, do we want a Mauritian tax resident trust or a foreign tax resident trust? Settler family circumstances play a role. If we have spouse and dependents who will also be Mauritian tax residents, that can be a great tax planning opportunity. I'll explain to you that there's the opportunity to what we call split income amongst dependents in a very tax efficient manner, which is obviously going to work nicely if we need more in Mauritius because we're paying for school fees and we're doing various things in Mauritius that requires expenditure in Mauritius that you would need to justify to the Mauritian Revenue Authority, the MRA. So those will be the factors that we'll need to take into account. Reasons to keep the trust. As I said to you, keeping the trust is actually all the more important, particularly from a tax point of view. But all the traditional reasons that are not necessarily tax related for keeping your trust continue. Just because you don't have a state duty, so there's no donations tax and no estate duty in Mauritius for Mauritian tax residents, but it may not necessarily be your retirement place or the place where you will end your days. It may just be a transitional place, and unfortunately, a lot of the expatriates who come to Mauritius, it has been more of a transitional thing than a permanent thing in the main. Possibly that may change in the future. But just because you don't have a state duty doesn't mean that the trust doesn't have a lot of value. Forced heirship rules, that's something which I think really is a webinar I could possibly do in its own right at some time, because if your client is coming from France or Napoleonic Code related countries, you're familiar with the concept of forced heirship and that you cannot disinherit your children. But in civil law jurisdictions such as South Africa, such as most of Africa, such as the UK, it's a foreign concept that I have a small portion of my estate that I have the freedom to determine who I leave it to. So that doesn't work for certain people, and particularly spouses who have an out-of-community regime with their husbands would have issues with that if they've been a homemaker and not been making the money. And what happens now, I'm basically at the mercy of my children and their spouses in terms of my financial needs later on in life. If take the traditional situation, if the breadwinner is the husband, if my husband predeceases me. So using a trust, there are certain anti-avoidance rules that apply to forced heirship, but over a period of time, if structured correctly, you can effectively lawfully avoid forced heirship. We're not predominantly doing this in order to do that, but the effect over a period of time will be to free up assets that won't be linked back to a deceased person's estate for forced heirship purposes, and give you the freedom. You have very, very wealthy people who may decide, you know what, my children will get 10% of my estate, the rest goes to charity. Forced heirship doesn't allow that. So that's an important reason to keep your trust. Protecting heirs, estate transfer planning issues, all the traditional things for those who are listening that are STEP members. You'll obviously be very aware of the benefits of a trust for various estate planning related reasons, which ensures that heirs receive the right assets at the right ages for the right reasons, and no arguments in between. But the tax advantages are what I'm going to focus on as to why it is actually very important to keep your trust as a Mauritian tax resident. And I'll explain to you, we can lawfully avoid this very unpopular solidarity levy that's been thrust upon individuals, which effectively pulls the individual tax rate to rates that are not encouraging to move to Mauritius. But we'll work through that and we can get around that. So particularly if you're not just an employee that's subject to the whims of your employer, where you don't have those structuring opportunities, if you own your own business and you manage your own affairs and your own wealth, you do have opportunities to structure the way in which your income is earned and so on, so that we can divert most income through dividend-related arrangements to your trust rather than a salary or director's fees to you personally, where you will be faced with quite significant Mauritian taxes at this stage, unfortunately. But as I said, there's definitely ways around that. So we've decided that keeping the trust is a good idea. Then the question is, do we keep it in Mauritius or do we move its tax residency elsewhere? So let's look at the case of keeping your trust in Mauritius. So from a planning perspective, what's going to make sense, you have your Mauritian trust. Okay, sorry, let me put a pin in that because I need to go back and just give you a little bit of, it's not in the notes here, but I think it's important for you to be able to understand how trusts are taxed in Mauritius if we have a Mauritian tax resident trust. So unlike a lot of other legislation that taxes trusts in a very different manner, the MITA, the Mauritian Income Tax Act, really treats a trust exactly the same as a domestic company. So the definition of a company in the MITA includes a trust and a foundation. And really all the tax rules that applies to companies, in fact, also applies to trusts. So in the ordinary context, a trust is taxed exactly the same as a domestic company. There could be, which is generally a 15% tax rate on most types of income, particularly if they're Mauritian sourced. There's a 2% corporate social responsibility levy. It's effective 17% tax rate on profits. But there is a reduced tax rate on foreign dividends, foreign interest, those types of things, which will become clearer. The only disconnect that you'll find in the MITA, where trusts are looked at on their own, is in section 46, which I mentioned earlier, which relates to that annual exemption, which is no longer going to be applicable in this topic, in this scenario, and also clarifying that distributions from a trust to beneficiaries are considered to be dividends, as if it's a dividend from a company. So if a Mauritian resident or any person receives a distribution from a trust, from a Mauritian point of view, it's a local dividend. Okay, and I'll explain later. Local dividends are not subject to income tax. So the 15% personal income tax does not apply to local dividends, like you'd have a local dividends from your GBC or from your domestic company. Same thing applies, but it is those dividends will be subject to solidarity levy, which I'll explain in a bit more detail in a moment, which to the extent that all your income, including local dividends, exceeds 3 million rupees, then the solidarity levy kicks in at the rate of 25% with an average of 10% at the end of the day. So it's something that is worthwhile ensuring that one tries to structure in order to lawfully avoid. So we've got our Mauritian Trust. We are now going to make sense for us in terms of your client or yourself, if you are the one looking at this decision. You don't necessarily want to bring all of your pre-residency capital from France, from the UK, from Africa into Mauritius and bang it into the Mauritian Trust. Mauritian trusts have their own issues because it's not really a separate legal entity, and it's actually the trustees that hold the assets. You want to put those assets into a company, and you don't want that company to be a Mauritian company. So the idea would be that you would establish a company, or your trustees would establish a company outside of Mauritius, ensure that central management and control takes place outside Mauritius, so it's not a Mauritian trust, a Mauritian company for tax purposes, and through either transactions involving a sale of your personal assets from where you used to be into that company, or a donation of assets into that company, which is effectively a donation into the trust, which from a Mauritian perspective, there's no donations tax. We have both choices available to us. We would want to capitalize those assets into that company, and then also have a system whereby we've already got our Mauritian Trust. Our Mauritian Trust, say, gets active dividends from a successful GBC in Mauritius, or the old GBL1, and we will want to channel those dividends through the trust into the company, and make our passive investments and our family wealth building happen there. In this way, it's going to be very tax efficient from a Mauritian perspective. Where would we want to put that company? Really, most jurisdictions is not a problem. It's usually a question of having a service provider that you're comfortable with rather than the jurisdiction. Obviously, you want to be in a jurisdiction that's effectively a tax-free jurisdiction. And then it's a question of, to the extent that that entity ever generates revenue from a Mauritian source, we would obviously ideally like to have DTA relief. So I've mentioned there the low tax jurisdictions with which Mauritius has double tax treaties. Of those, I would say Luxembourg is really quite expensive, and probably if you're going to be using Luxembourg, you're probably going to be using a Swiss trust anyway. Barbados has its issues with compliance and blacklisting at the moment. So does Seychelles, in fact. UAE culturally can work for some, maybe not for others. So Guernsey and Jersey I like, but again, it's not cast in stone. It's just I'm just making an illustration. So then what does the settler do with assets that they have taken out of their country of residency, if they choose to, or changing ownership where they used to live, and they want to put it into this company? Do they do so by way of sale or by way of donation? There are pros and cons regarding both of them. So if we go the sale route, then you create a nice loan account and ability to pull out clear pre-residency capital and bring it into Mauritius and not be exposed to tax in Mauritius. However, that loan account will be required to have an interest rate attached to it in terms of general anti-avoidance rules and a slow embrace by the MRA of international transfer pricing. It would be expected that you need to charge interest, but it's a kind of it's not really too relevant, because unless you get paid and remit that interest into Mauritius, it won't be taxed. And if you make sure that you keep your interest any interest payments in a separate bank account to the repayment of capital. You can clearly show if you have capital repaid, your loan account repaid to bring money into Mauritius. If you need money into Mauritius, it'll be clear that there'll be no tax associated with that. Donation means that you're going to now irrevocably transfer the assets into the company stroke trust structure, which then, yes, your estate is depleted. You have various estate asset protection, estate duty, estate benefits. You don't have an estate duty issue as a Mauritian, so that's not an issue. But the issue is if you need to pull it back out, depending, again, if it's a Mauritian trust or an offshore trust, you're going to create tax issues. So you're taking after-tax capital, you're sticking it into the trust, and if ever you need to draw on that specific capital, you have to be very careful how you do that, because you could be creating tax on post-tax capital. So I prefer going the sale route, but again, it will depend on the circumstances, and there's no clear answer to that. So what are the advantages of keeping your trust in Mauritius? So what happens, let's take just as an illustration, let's take the situation where very simply we had our GBC, it's making good money, the shares were held by a Mauritian trust. Now the settler is becoming a Mauritian, so now the trust is no longer exempt. Firstly, it receives, its only income at this point is dividend income from the GBC, which is exempt, it's not taxable. And there's no solidarity levy, there's no individual solidarity levy for a trust, okay? If you were, unenlightened enough to hold the shares in your GBC or your domestic company in your own name and you receive dividends, you're going to be exposed to significant taxes in the form of the solidarity levy, which, they talk about an average solidarity levy of 10% on all of your income, but effectively your first 3 million rupees of income and dividends, there's no solidarity levy. As soon as your income and local dividends exceeds 3 million, then the solidarity kicks in. For the next 2 million of dividends, it kicks in at a flat rate of 25%. That's very punitive. And that's after having paid, 15 to 17% in the company. So now that's a lot of tax leakage that's happening. So it makes no sense having the shares in your name. It makes sense having the trust. Now the trust gets tax-free dividends. It then invests those dividends in the foreign company. The foreign company grows its assets from sources outside of Mauritius through a portfolio of investments and properties and whatever it is that the settler and the trustees agree to. And if and to the extent that drawings are required out of that trust, particularly if the settler has dependents, let's say spouse and children who are Mauritian tax residents, it's going to be any distributions to them which are completely discretionary and any allocation as you wish, which wouldn't be the case for shareholders of a company, but it's treated as a company. So we can choose to give each child, whether that child's 3 months old or 25 years old, as long as they're not earning income. The first 3 million in distributions from that trust is tax-free. So if you have 3 children and a spouse, they're not earning an income. Spouses generally still, the authorities in Mauritius don't really permit spouses of expatriates coming in here to have the freedom to work here without applying for a permit, which may or may not be granted. So that's one way of using the tax base of your dependents in order for them to each take 3 million each. And I don't think, those people certainly don't need that kind of money to spend in Mauritius. So really, you can structure your affairs that you receive directors' fees to the tune of not more than 3 million from your GBC as an investor. Under investor permit, you pay your 15% tax. That's the only tax you need to pay. Okay? There's no requirement to pay corporate social the CSG, the new pension contribution, which is a 9% tax, because as a expatriate, you're never going to benefit from it. It's an additional 9% tax, plus an additional 25% solidarity levy. They can all be lawfully avoided. You pay your 15% on your 3 million. The rest goes into your trust as dividends. Your family can each take 3 million a year out of the trust, not pay tax at all. You have the additional advantage with the Mauritian Trust is that it permits settler control. The residency of the trust, which is the only other differentiator in the meter as to how a trust is taxed in Mauritius. Unlike companies that work on the concept of central management and control, Mauritian trusts don't in terms of determining their tax residency. It works on either the majority of trustees and administration is in Mauritius. So if one or the other isn't in Mauritius, it's not tax resident in Mauritius. It may still pay tax on Mauritian sourced income, but remember, if all the only Mauritian sourced income is dividends from a GBC, that's tax exempt anyway. Or the settlor was tax resident in Mauritius at the time that the instrument creating the trust was signed. So we're talking about a technical settler. And that now becomes an issue. Now your client comes to Mauritius and says, oh, I didn't do a trust. I've become a Mauritian tax resident. Let me go and form a trust in the BVI. I'll say, well, we've got a problem because you can't be the settler because it'll be a Mauritian tax resident trust, even though it's managed and controlled and has trustees and administration in the BVI. It's a Mauritian trust. You're taxed in Mauritius like a Mauritian company. So that's where foundations play a role because we don't have that settler issue on the tax residency. So again, these will be different criteria to look at, which I'm digressing from because we've really got our Mauritian trust. We're choosing to keep it in Mauritius for a number of good reasons, particularly if we're not talking about massive wealth, particularly because we can put excess wealth in a company that sits outside of Mauritius. If we ever want to move the tax residency of that trust from Mauritius to another place, there won't be exit taxes. There's no CGT in Mauritius. So to move the residency of the trust elsewhere, redomicile the trust to another jurisdiction would have no tax implications, which is not quite the same in a lot of other countries. So we're very flexible here, and starting off with the Mauritian trust makes a lot of sense. In addition, for those who have these issues with trustee control and what have you, don't have that problem. We're not working on central management and control. We are happy to have the trust as a Mauritian tax resident trust for the time being, but you may want to be a co-trustee or a protector to the trust and make decisions with the trustees and feel that you've got necessary control. That's definitely a benefit, which to some extent you can still have with a foreign trust, but it's probably nicer to have your trustees down the road where you live rather than in some other country. Then what would happen is, to the extent that you need to pull the capital that's sitting, or the funds that are sitting in the holding company through to Mauritius in order to distribute to beneficiaries, you've got two choices. You either pass dividends from the holding company to the trust, which will be subject to an effective 3% tax rate. Or you could, in fact, I haven't put it in the notes here, you could actually redeem shares after a few years and generate a capital gain, as long as it does not constitute a dividend according to the Mauritian Income Tax Act, which it shouldn't. And you're then generating, you're liquidating capital from the company, which would then not be taxed in Mauritius and in the trust name. And obviously the distribution out of that trust, as I've explained before, the first 3 million per dependent. But obviously, if you're already subject to tax on 3 million and you're now making a further distribution from the trust, that will be subject to solidarity levy. So you need to take that into account. Plus, you're able to show substance because you're close to your trustees and there's no issues about who controls what. It's suitable if distributions are required in Mauritius for local living expenses, particularly if you're receiving Mauritian resident income in the form of dividends from GBC. It makes perfect sense. If you already have a GBC trust structure, keep the trust. It makes all the sense in the world, and then you'd have an offshore holding company to do other investments, and it's very efficient, and you have the best of most worlds. Disadvantages, this could be a push, and it's a perceptional thing. This is not my particular personal views, but you may comparatively say, listen, Jersey, Guernsey, Isle of Man, the laws there are better, the court system is better, the precedent is better. Mauritius is going through a period of some EU issues on banking level. You may take a view on political or country risk, and that may be a relevant argument. If you're talking about an ultra high net worth individual, we're talking about $40-50 million plus type of situation where you may feel it's more appropriate to be in a safer jurisdiction. I don't particularly share that view completely, but I do understand from a perceptual point of view that certain high net worth individuals may take that view. Okay, so where are we time-wise? I've got 5 minutes. So let's compare that to redomiciling the trust out of Mauritius. Okay, as I mentioned, forming a new trust out of Mauritius is going to be a problem unless someone else is the settlor. And then our settlor, our commercial settler, is not a problem being a commercial settler, is a problem being a technical settler. Otherwise, you make the trust a Mauritian tax resident trust. But we do create compliance problems if the true settler, the true commercial settler is not the same as the technical settler, and who should their technical settler be, and where they're resident, and there'll be CRS reporting issues there, and this, that, and the next thing. And ideally, trustees generally don't like entertaining those types of arrangements anymore. So re-domiciling the trust, as I've mentioned before, may be more appropriate for very sophisticated and ultra-high net worth individuals who need skilled family offices, where they may feel that Mauritius is a little bit too far from the action in terms of where they want to invest their money and the skills that they need in order to do that. I mentioned there reducing withholding tax on Mauritian source income. Again, I have come across that, so I put it in here, but I don't think it's too relevant. And the idea is generally not to shift all your assets to an entity outside Mauritius and then generate revenue from a Mauritian source. That's generally not what we try to achieve, and it doesn't really make necessarily sense to do so. So again, if you've got, if there are dependents that have substantial non-Mauritian related expenses, it could be boarding school expenses in the UK or in France or America, or university fees, or elaborate travel expenditure, then having that trust outside makes sense, because any distributions will not be taxed. They'll be considered foreign dividends, and they're not taxed until and unless they are remitted into Mauritius. So if they're never remitted to Mauritius and they're expended out of Mauritius, then the offshore trust has value because there's no exposure to taxation. Also, it can be good, as sometimes, Mauritius works on source in various respects, particularly with distributions to individuals, and you don't want to have a fight with the MRA as to whether it's Mauritian or non-Mauritian sourced. And if you're using a Mauritian trust that now sends money out, then brings it back, there could be a case, well, originally it was Mauritian source, and then you sent it out and you put it through a structure, now you brought it back, it's really Mauritian source. There could be that argument. By having the foreign trust structure, it puts that type of argument beyond any debate, in that it's very clear that this was pre-residency capital that never came into Mauritius, and if it does come into Mauritius at some point, it's foreign sourced. So this is really suitable if pre-residency or most of your pre-residency capital is not needed in Mauritius, particularly, you can bring it into Mauritius in one way or another, but it would be more of a once-off. You need to clearly show that this is pre-residency capital. And you don't need to live on it every month, and again, it depends on what your income and expenditure requirements are. So I think this is my last slide, the disadvantages. So there's a big sting in the tail by having your offshore trust. If you, in terms of your non-Mauritian tax resident trust, require distributions from that trust which are brought into Mauritius, you're going to get penalized, because firstly, it's not a local dividend, so you're going to pay the 15% normal income tax to the extent that you bring it in. Plus, no doubt, if that exceeds, if that distribution is going to exceed your 3 million limit on total income, then you're going to pay the solidarity levy, and where your income, including dividends, is between about 3 and 5 million rupees, you're going to pay a flat rate of 25%, plus your 15% tax. That's 40% tax. So that you don't want to do. And having loan type structures may be attackable from the MRA on the basis that, unless it's done on a very clear arm's length basis, there may be issues with that as an argument to say you're avoiding, you're basically making use of something that would otherwise have been income. We want to avoid that, because you don't really want to go to court in Mauritius with the MRA. It's not something that you ideally would like to do. Transfer pricing, obviously, there'll be deemed interest on the loan accounts. As I said, that's probably not a big issue as long as you don't bring the interest back into Mauritius. There may be some degree of restriction on settler control. Again, not such a big issue in Mauritius, because we don't work on central management control for foreign trusts. So for you as a Mauritian protector to that trust, that wouldn't be a problem, as long as you're not the technical settler, and as long as the trustees and the administration is happening elsewhere. So it's not suitable if you need to bring back a lot of income in order to sort of augment your living expenses in Mauritius. So hopefully I've illustrated, the basics of, firstly, the message is absolutely you need your trust. In fact, it's more important than ever before in your Mauritian tax planning. Number two, in most circumstances, keeping your Mauritian trust is probably going to work very nicely. But in certain circumstances, there is a case for certain types of clients to move your trust out of Mauritius. And the way you do it is you take your Mauritian trust and you just re-domicile it elsewhere. You may well keep the administration here and keep your service provider for administration, but then the trustee will become a foreign trustee, and then it's no longer a Mauritian tax resident trust. Okay, so there we have it. I'm now going to attempt to answer some questions. So, sorry, I'm just going to put up my contact details. So that's me, Korten Consulting Limited. Say I practice from Mauritius. I do travel often to South Africa, obviously not in the last year, or probably the next year. But if I'm not able to answer all your questions, or if you have any questions, you're welcome to drop me an email or have a quick call. I'm happy to spend a short time on the phone to help you out. It's not a problem. Okay, so let's have a look at some questions. Has the government, okay, I don't have the name of the person on these questions here. So someone has the government changed the legislation? There are lots of abuse creating fake trust just to evade tax and money laundering. The answer is no. Okay, the answer is no. There's no change to the taxation of trusts as such, according to the laws of Mauritius at this point in time. And again, abuse, fake trusts, evading tax, money laundering, at the end of the day, money laundering, as you well know, we have an unfortunate blacklisting status, which hopefully is very temporary, and that relates to just not having the sufficient controls according to the OECD in order to make sure that the necessary checks are made in terms of fund flows through the country. I don't think trusts are the issue. Trusts have become very transparent. The OECD and the rules in Mauritius have required that beneficial owners of trusts, having blind trusts with the SPCA as the beneficiary and some technical set law, these things are a thing of the past, and the laws of Mauritius are pretty sophisticated and pretty all-encompassing in terms of ensuring that the true beneficial owner is there, that there's a register of those owners. You can't have these secret trusts. Banking here is very careful to ensure that distributions are made in the right way, and what goes in and what goes out is carefully checked as to where it comes from and what it's for. Tax is that's not Mauritius's concern. At the end of the day, the sort of the way in which we report, Mauritius is absolutely on board with reporting in terms of FATCA, in terms of a CRS. So in that respect, I don't think Mauritius is an easy breeding ground to hide money. Quite frankly, there are other jurisdictions that are far easier to do so. And certainly the tax laws relating to trusts have not in any way changed. Next question. Okay, to avoid the 15% tax on the Mauritian trust once the settler moves to Mauritian, wouldn't it be easier for the settler to close the Mauritian trust and set up a trust in another jurisdiction with foreign trustees before becoming? Yes, what I explained to you is that really necessary? So I think maybe you've asked this question in early on in my presentation, and hopefully my presentation would have illustrated that in fact sometimes you're better off with the Mauritian trust, particularly if you need to draw distributions in Mauritius for your living purposes. You're better off with the Mauritian trust. Okay, so there are various benefits. Sorry, can you just bring that back down, because I want to look at that question. So yes, you could. You could just re-domicile the trust. You wouldn't need to necessarily reopen it. But yes, if you don't want the trust in Mauritius, now again, where are you going to pay 15% tax? On your dividends from GBCs, you're going to pay no tax. Your trust is not going to be used as a trading entity, and your trust is unlikely to be used as an investing entity. And I've considered using your offshore holding company. Unlike South Africa, where you have all of these exchange control looping problems and what have you, if you so wish, your trust could capitalize a foreign company, and that company could invest in Mauritius, but it'll be taxed in Mauritius in a similar way. There'll be withholding taxes on interest at 15%, all the rest of it, again, subject to DTA relief. So generally, you could structure your Mauritian trust. You're not going to pay 15% tax on your dividends. You're not going to pay 15% tax on your foreign dividends. You'll pay 3% tax. Or you could just liquidate or redeem shares in the company that sits overseas and generate a capital gain. If now and again you do one big transaction and you bring money back, and that can be dispersed. The key issue is the disbursement of that from the trust to the individuals. There you are potentially exposed to tax. It's not really the trust that's exposed to tax, because it's seen as a local dividend where the solidarity levy would apply. Of course, if that distribution is made to another Mauritian company that could be a beneficiary of the trust, then again, we don't have that problem. For example, you may say, now I want to buy a nice property in Mauritius. I need to bring money in. So what we do is we liquidate, we convert capital from the offshore company in Mauritius, and we then make a distribution to a domestic company in Mauritius that is possibly 100% held by the trust, that will then capitalize that company to buy the property. And again, we have no tax problem. There's no tax on the inflow of that money. So there are various ways to swing the cat in that regard. And I haven't often found that it's that necessary to form a new offshore trust elsewhere before moving to Mauritius. But I'm not saying it's never appropriate. It might be. And certainly if the decision is we need to move our trust out, and if for whatever reason we don't want to re-domicile, but we want to start afresh with a new trust, then yes, we would want to do that before we become Mauritian tax resident. Otherwise, that Mauritian trust has the stigma of being tax resident because the technical settler was Mauritian resident. Next question. Okay, you've spoken about Mauritian Trust. Are the tax implications fundamentally different if the foreigner has a Mauritian foundation? Mauritian foundations and trusts are identical, except the tax residency of the Mauritian Foundation is somewhat similar to a company in that it doesn't refer specifically to, there's no settler problem that we have with the trust. So what I've done in the past, where we have decided that we want a foreign clients coming to Mauritius, they don't have a trust, they had a structure, they had a setup, it worked for them. Now they're moving to Mauritius, they don't want a Mauritian trust, they'd rather have an offshore trust. Trusts are a problem, so we form a foundation. So we formed a foreign foundation, and that took up, or we sold the shares in the Mauritian company to that foundation. But the foundation will be treated basically, other than its tax residency definition, will be treated identical. Sorry, you want me to read this? Okay, so Mark mentioned that if the Mauritian resident sets up a foreign trust, then the trust will still be tax resident Mauritius, but this does not apply to a foreign foundation. Okay, so I think I've just elaborated on that. There's a distinction. In the Mauritian Income Tax Act, Section 73, there's a very specific and quite strange concept that a trust is Mauritian tax resident forever and a day if the settlor was Mauritian at the time that the instrument creating the trust was established. It means that if you set it up as the technical settler, that trust is always a Mauritian tax resident trust, obviously subject to double tax treaty relief, which may or may not be something that we're going to get. Foundations don't work like that. Foundations are a separate legal entity. It's a different animal. It's not something that South Africans understand, because we don't, in South Africa, foundations, they don't exist. So we haven't used foundations a lot for South Africans, because the foundation will either constitute a company or a trust according to South African law, including trust law. And of course, we don't want it to be a company, so we have to set up the foundation with all the essentials of a trust, but based on foundation's law principles. But the taxation will be the same. The only problem is the tax residency in terms of establishment, where you don't have the same settler problem when you establish a foundation. Right, another question. Following COVID-19, the economy is affected massively, and also everything else happening. How safe is it still to have a trust in Mauritius, and how safe is our investments in Mauritius? I don't believe it's any different to before. Everywhere in the world, economies are suffering, and Mauritius is not an exception. But Mauritius, as you know, is COVID-free and only had COVID for 2 or 3 months. I think probably one of the few countries on the planet. So, in that regard, it's fantastic. Obviously, we're very reliant on tourism and all of the other industries that relate to tourism. And that's, of course, still taking a lot of strain. So whether it's travel, tourism related, Mauritius is having a tough time there, and is likely to continue to. And obviously, we're very, very scared about a second surge if we start allowing tourists back here, which hasn't happened yet. But other industries are doing very well. But to answer your questions, the rule of law the country as such is no different to pre-COVID. I'm not saying your Mauritian Trust must necessarily hold Mauritian investments, but it is the vehicle that owns it. And if you're living here, you're a co-trustee, you have all the benefits like a South African family trust, for example, where you're a co-trustee, possibly even having a veto, and you've got your professional trustee, which the Mauritian laws require. And you have the various estate planning and asset protection benefits of that trust, but your assets are sitting elsewhere. But the laws of Mauritius have not been compromised during COVID. If anything, they're getting tighter and tighter. And Mauritius, because financial services in the offshore sector is becoming a more and more important part of Mauritius's economy, it will do everything that it can to ensure that it complies with international norms and rules. It's not going to be a case where the rule of law and things become chaotic here. I just mentioned that the litigious system here, if you have a fight with the MRA or there's a litigious issue that develops within your trust, if that's a real concern and we're talking about big money, again, you could have Mauritian trustees but apply Guernsey or Jersey law to your trust deed and dispute resolution and the way in which one goes about. So that's often what we do. We use Mauritius as the tax residency. We use Mauritius for the trustees and for the administration, but the law of the trust deed and the forum for dispute resolution is a better, possibly a more certain jurisdiction with a better legal precedent. I note your reference to Jersey and Guernsey for the holdco. What about Isle of Man? Isle of Man's great. We've got no problem with Isle of Man. The only thing is Isle of Man, to my knowledge, there's no double tax treaty with Mauritius. And that's, as I said, not an issue if you're not generating Mauritian sourced income in your Isle of Man company. But if you are, and for example, you may choose to lend money, you may choose to charge interest, there's going to be 15% withholding tax on the interest unless there's a DTA, where Jersey, Guernsey, you won't have that problem. But there's nothing wrong with the Isle of Man. So if you're not generating revenue from Mauritian source, which I think the idea is you generally wouldn't, but if you are not generating revenue from Mauritian source, that other than dividends, there's never withholding tax, it's tax-free, or capital gains and dividends. But if you're generating royalties, rentals, interest, any other, that's the only other passive income I can think of that a trust would generate, or even a holding investment holding company, then it's not a problem to not have tax treaty benefits, and Isle of Man is perfectly good idea. At what income level would you advise high net worth individual clients in Mauritius to set up a trust so that the cost of the trust can be compensated by tax efficiency? Well, it's actually very low. I mean, anything over, again, we're now assuming that your client is not an employee that's subject to employment income with a third-party employer, where they don't have the option necessarily. Although some executive managers who I have coming to Mauritius, I set up consulting companies as the means for which they render their services to whoever it is that's asked them to come to Mauritius to run something, rather than being an employee. Otherwise, their tax goes through the roof. And either the employer has to pay for it or the employee, and you have a 49% tax rate effectively between 3 and 5 million. So I think the answer to you is 3 million rupees. I mean, you can't, as an expat for the most part, if you've got dependents and children at private school, you can't live on 3 million rupees a year, net. So, less 15%. Expatriates who come here, that's $5,000-6,000 a month. Just between the rental of your house and your school fees, that takes that up. So anything over 3 million, you're going to want the trust. The trust, again, your service provider, I'm not going to start quoting what a trust costs. You'll find that out yourself. But it is generally, when you're exceeding 3 million and you're now paying 25% solidarity levy, very quickly you realize the trust makes sense. Does the inheritance laws in Mauritius override the benefits of holding property in a trust? Again, if you become a Mauritian and you're domiciled in Mauritius at the time of your death, then you're subject to forced heirship on your worldwide assets. But even if you don't, if you have Mauritian immovable property, in theory, you are still subject to these probate rules in Mauritius, even if you stay a UK resident or a South African resident. So, and the fact that you stuck it into a property, it depends how you structure it, because as I've mentioned, there are anti-avoidance rules that try to sort of get round you diverting growth from your name. So, for example, if you donated cash to the trust, and the trust then bought the property. Okay, on your death, the property in that trust will deem to be part of your estate for probate purposes. They'll look straight through. You know, if you lent money to the trust, so at least we have the growth of that property in the trust, they will attach a market-related interest rate to that loan that goes back into your estate for probate purposes. So over a period of time, say you're getting a loan from the bank, you're putting a small amount in, we charge interest, or there's a deemed interest for probate purposes, the property grows in value, derive rental income, whatever the case may be. Eventually, to a large extent, you allow for that growth to escape probate rules, but not necessarily completely. And obviously, you need to structure it correctly from the word go, and it'll be a passage of time, and growth you can peg the value where the growth is not necessarily part of your estate, other than maybe a market-related interest rate attached to the loan that you provided to the trust. Please confirm, how are we doing for time? We are we're what, 4 minutes? 2 minutes. Okay, so last question. Please confirm we can obtain a recording of this presentation. I'm sure I'll need to go through again. It is quite technical. Yeah, and I understand it. Sorry, I needed to rush because there's a lot to cover, and for certain people, it's not sort of common knowledge or easy to understand. So the answer is absolutely yes. The AfrAsia team will circulate the replay by mail. So I think if you email them, I'm not sure. Are you going to actually send to everybody the recording? Okay, fantastic. So you all get the recording, so you can share it with your colleagues or listen to it again. Yeah. So hopefully that was informative. Hopefully you didn't confuse you too much, and gave you some ideas of what's involved and how important it is, in fact, that we continue to have the trust. And then we just have a little closing statement, and we should be done.
Well, that was very informative, Mark. Thank you for showing us and giving us the elaborated overview on the use of Mauritian Trust, at the same time complying with the economic substance rule, which is now a must in everywhere else. It was a pleasure to have you here, and thank you for your time.
Great, thanks. Thank you, everybody, and goodbye.